Are you tired of watching your hard-earned money disappear to taxes? What if I told you there are 10 powerful investment strategies that can cut your tax bill starting right now? These aren't your typical tax tips. These are game-changing moves that got massive upgrades in 2025. A brand new law called the One Big Beautiful Bill Act just changed everything. It was signed on July 4th, 2025, and it created incredible new opportunities to slash your taxes legally. Some of these strategies are completely new for 2025. Others got supercharged with better benefits than ever before. Today, we're diving deep into the most effective tax-reducing investments available right now. By the end of this video, you'll know exactly how to use these 2025 changes to keep more of your money and build wealth at the same time. Let's jump right in. Chapter 1. The brand new Trump accounts. First up is something completely revolutionary. Trump accounts are the newest investment vehicle created by the One Big Beautiful Bill Act. If you have kids or grandkids, this could be huge for your family. Here's what makes these accounts special. The government gives you a free $1,000 to start. But there's a catch. This only applies to kids born between January 1st, 2025 and December 31st, 2028. It's a pilot program, so this window is very limited. Any U.S. citizen under 18 with a social security number can have a Trump account. You can put in up to $5,000 per year with after-tax money. Starting in 2027, this limit goes up with inflation. But here's where it gets really interesting. Your employer can contribute up to $2,500 directly to your kid's account. This doesn't count as income to you. It's completely tax-free money for your child's future. Even better, cities, states, and nonprofit organizations can contribute without limits. This creates a powerful funding source beyond just family money. The tax benefits during growth are incredible. All investment earnings are completely tax-free while your child is under 18. No kiddie tax, no income reporting. The money just grows without any tax drag. When your child turns 18, the account becomes like a traditional IRA. They can use the money for education, starting a business, or buying their first home. There's one rule though. Any money left at age 31 must be withdrawn and taxed. Let me show you the power with real numbers. Say you put in $5,000 every year from birth to age 18. With a free $1,000 start and 7% growth, your child could have over $180,000 by age 18. All of that growth was completely tax-free. Now, imagine if your employer adds $2,500 per year. You could be looking at over $250,000 by age 18. That's life-changing money for college, a business, or a house down payment. The catch is, this is a pilot program. We don't know if it will continue beyond 2028 births. There are also concerns about whether it will really help lower income families or mainly benefit those who are already wealthy. But if you're eligible, this is an incredible opportunity. Free government money plus tax-free growth for 18 years is hard to beat. Now, let's look at another account that gives you triple tax benefits and works for any age. Chapter 2. Health Savings Accounts, the triple tax winner. First up is the Health Savings Account, or HSA. This is hands down the best tax deal in America right now. While HSAs didn't get direct changes in 2025, the new tax law locked in the rates that make HSAs even more powerful. You get 3 amazing tax benefits. First, you put money in tax-free. Second, your money grows tax-free. Third, you take money out tax-free for medical costs. No other account gives you all 3 benefits. For 2025, you can put in $4,300 if you're single. If you have a family, you can put in $8,550. If you're 55 or older, add another $1,000 on top. These limits go up slightly in 2026 to $4,400 and $8,750. Tax rates are now locked in permanently. This means the tax savings you get from HSA contributions are predictable for decades. No more worrying about rates jumping up and reducing your benefits. But here's the secret most people miss. You don't have to spend HSA money right away. You can invest it and let it grow for decades. After age 65, you can use HSA money for anything. You'll pay regular taxes then, but you got decades of tax-free growth. Most people make a huge mistake with HSAs. They keep all their money in cash, earning almost nothing. The smart move is to invest HSA money in low-cost index funds. Over 20 or 30 years, this can turn into serious wealth. Here's a real example. Say you're 35 and max out your HSA every year. You invest the money and earn 7% annually. By age 65, you'd have over $650,000 tax-free. With the new locked-in tax rates, you can plan on this with confidence. Now let's look at retirement accounts that got even better certainty this year. Chapter 3. Traditional 401k and IRA. Traditional retirement accounts are your bread and butter for tax savings. Every dollar you put in reduces your taxes today. The big news for 2025 is that your future tax planning just became crystal clear. You can put $23,500 into a 401k. If you're 50 or older, you get an extra $7,500. That's $31,000 total. If you're between 60 and 63, you get an even bigger catch-up of $11,250 extra. This higher catch-up amount is brand new. Traditional IRAs let you save $7,000 in 2025. Add $1,000 more if you're 50 or older. The key is getting the tax deduction. If you have a workplace retirement plan, the deduction phases out at higher incomes. Here's the game changer for 2025. The One Big Beautiful Bill Act locked in current tax rates permanently. The top rate stays at 37% instead of jumping to 39.6% like it was supposed to in 2026. This gives you incredible certainty about what you'll pay in retirement. Let me show you the power with numbers. Say you earn $100,000 and put $20,000 in your 401k. You only pay taxes on $80,000. In the 22% tax bracket, that saves you $4,400 in taxes this year. The money grows tax-free until retirement. Yes, you'll pay taxes when you withdraw, but now you can predict those tax rates with confidence. If you're in a lower bracket in retirement, you win big. One strategy many people use is the rule of 55. If you leave your job at 55 or later, you can take 401k money without the 10% penalty. With the new tax rate certainty, you can plan this strategy with much more confidence. But what if you think taxes will be higher when you retire? That's where our next strategy comes in, and it got some interesting updates. Chapter 4. Roth accounts, your tax-free future. Roth accounts flip the script on retirement savings. You pay taxes now, but never again. For young people or anyone expecting higher future taxes, Roth accounts are pure gold. The 2025 changes make them even more attractive. Roth IRAs have the same $7,000 limit as traditional IRAs, but high earners get cut off. For 2025, single people making over $165,000 can't contribute directly. Married couples get cut off at $246,000. Here's the workaround that's more important than ever in 2025. Roth 401ks have no income limits. If your company offers one, you can contribute even if you make millions. This is huge for high earners, especially with the new tax rate stability. With tax rates locked in, you know exactly what you're paying now versus what you'll save later. The math is clearer than ever before. The real magic happens over time. Every dollar of growth is tax-free forever. Unlike traditional accounts, Roth IRAs never force you to take money out. Starting in 2024, Roth 401ks also eliminated required distributions. You can leave it all to your kids tax-free. Let's see this in action. Put $6,000 in a Roth IRA at age 25. Assume 8% growth. By age 65, you'd have over $1.3 million completely tax-free. With a new tax certainty, this planning is rock solid. The strategy for 2025 is tax diversification. Have some traditional accounts for today's locked-in tax break. Have some Roth accounts for guaranteed tax-free retirement income. This gives you options no matter what happens. Speaking of smart strategies that work great in the new 2025 environment, let's talk about helping others while helping yourself. Chapter 5. Donor advised funds. Donor advised funds, or DAFS, are the wealthy person's secret for maximizing charitable giving. The 2025 tax changes make these even more powerful than before. Here's how it works. You put money or stocks into a DAF. You get an immediate tax deduction. The money grows tax-free. Then you recommend grants to charities whenever you want. The tax benefits are massive. Cash donations get you deductions up to 60% of your income. Donate appreciated stocks and you can deduct up to 30% of income. Plus, you avoid capital gains tax on the stock appreciation. The tax law made the elimination of miscellaneous itemized deductions permanent. This means DAFs become even more valuable for tax planning. With fewer deductions available, charitable deductions become more precious. The secret strategy is called bunching. Instead of giving $10,000 every year, bunch 5 years together, give $50,000 in 1 year to a DAF. Take the huge deduction that year. Then grant money to charities over the next 5 years. This works better than ever in 2025 because of the higher standard deduction that's now permanent. Many people don't itemize anymore, but bunching large charitable gifts into a DAF can push you over the standard deduction threshold in high income years. Here's a real example. You normally give $10,000 per year to charity. Your income jumps to $500,000 1 year. Instead of the usual $10,000, you put $50,000 in a DAF. You get a $50,000 deduction when you need it most. Then you grant $10,000 per year to your favorite charities. The money in the DAF can be invested and grow. With the new tax rate stability, you can predict the long-term benefits better than ever. Now let's shift gears and talk about business owners. If you own any kind of business, the 2025 changes created some incredible new opportunities. Chapter 6, Small Business Tax Deductions. Massive new benefits for 2025. The new tax laws created permanent benefits and brought back powerful deductions that were disappearing. First is the Qualified Business Income Deduction, or QBI. This lets many business owners deduct 20% of their business income. This deduction was supposed to expire at the end of 2025. The new law made it permanent forever. The deduction works for sole proprietors, S-corp, partnerships, and LLCs. There are income limits and restrictions for some service businesses, but most small businesses qualify. Equipment purchases got supercharged too. Bonus depreciation went back to 100% for qualifying property placed in service after January 25th, 2025. This was phased down to 40% in 2025, but the new law restored full 100% through 2029. Let me show you the impact. Say your business makes $200,000 profit. The permanent QBI deduction saves you $40,000 in income that gets taxed. In the 24% bracket, that's almost $10,000 less in taxes every year forever. Add in immediate R&D expense and 100% bonus depreciation, and you could potentially zero out business income in high investment years. Plus, you should know, business expenses are broadly deductible. Office supplies, software, internet, phone bills, business meals at 50%, professional services, insurance, and much more. If you work from home, you can deduct part of your home costs too. The key is keeping good records, separate business and personal expenses. Save all receipts. The IRS is tough on business deductions, so documentation is everything. For business owners ready to think bigger, our next strategy involves real estate investing that got massive upgrades for 2025. Chapter 7, Short-Term Rental Loophole, supercharged for 2025. This strategy just became incredibly powerful thanks to the 2025 tax changes. Short-term rentals can generate tax losses that offset your regular income. We're talking about potentially massive tax savings that got even bigger this year. Normally, rental losses can only offset rental income, but short-term rentals with average stays of 7 days or less get special treatment. If you materially participate in running them, losses become active and can offset W-2 wages, business income, or any other active income. Material participation means spending more than 500 hours per year on the rental. This includes cleaning, maintenance, guest communication, bookings, and management. You need to track these hours carefully. Bonus depreciation went back to 100% for qualifying property through 2029. This was supposed to drop to 40% in 2025. But the new law restored full immediate write-offs. The tax magic comes from depreciation. Real estate depreciates over 39 years for short-term rentals, but you can accelerate depreciation using cost segregation studies. This identifies parts of the property that depreciate faster. With the restored 100% bonus depreciation, personal property inside rentals like appliances, furniture, carpeting, and landscaping can often be written off immediately instead of over many years. Let's see this work with 2025 numbers. Buy a $400,000 short-term rental. A cost segregation study finds $150,000 in personal property and land improvements. With 100% bonus depreciation restored, you might create $150,000 in paper losses the first year. If you're in the 32% tax bracket, that saves $48,000 in taxes. The property still produces rental income. You get massive tax savings plus cash flow. Over time, appreciation can build serious wealth. Here's another 2025 bonus. There's also a temporary 100% expense for qualified structures placed in service before 2031. This could mean immediate write-offs for certain building improvements instead of decades-long depreciation. But be careful. You must really materially participate. Keep detailed time logs. The average stay must be 7 days or less, and local regulations might restrict short-term rentals in your area. This strategy works best for high-income earners who can absorb the upfront costs and time commitment. What if you want real estate benefits without the short-term rental hassle? Let's look at traditional rental properties that also got 2025 upgrades. Chapter 8, Long-Term Rental Properties. New benefits. Long-term rental properties offer a more stable path to real estate wealth. The 2025 tax changes make these investments significantly more attractive than they were just months ago. Regular rental properties depreciate over 27.5 years. You deduct about 3.6% of the building's value every year. This creates paper losses that offset rental income and sometimes other passive income. Operating expenses are fully deductible. Mortgage interest, property taxes, insurance, maintenance, repairs, property management fees, and more. These expenses often exceed the rental income in early years, creating tax losses. Rental property owners with pass-through business structures also benefit from the permanent QBI deduction. This can provide an additional 20% deduction on net rental income. Let's see the numbers with 2025 benefits. Buy a $300,000 rental property. With cost segregation and the restored bonus depreciation, you might identify $80,000 in personal property for immediate write-off. Combined with regular depreciation and expenses, you could show a $90,000 tax loss even while receiving positive cash flow. Over time, rents typically increase with inflation. The mortgage gets paid down. Property values are often appreciated. You're building wealth while getting massive tax benefits. The key risks are vacancy, maintenance costs, difficult tenants, and market downturns. Rental property requires active management unless you hire a property manager. For investors willing to take on more risk for potentially bigger tax benefits, let's look at energy investments that got a nice 2025 boost. Chapter 9. Oil and gas investments. Oil and gas investments offer some of the most aggressive tax benefits available to individual investors. While complex and risky, they got a meaningful improvement for 2025 that makes them even more attractive for qualified investors. The biggest benefit is intangible drilling costs, or IDCs. These are expenses with no salvage value like labor, fuel, and site preparation. They typically account for 60% to 80% of drilling costs. You can deduct 100% of IDCs in the year incurred. Then there's the percentage depletion allowance. Once a well is produced, you can deduct 15% of gross income from the property every year. This continues for the life of the well, even after you've recovered your full investment. Working interests in oil and gas are treated as active income, not passive. This means losses can offset W-2 wages, business income, or other active income. Most other investments don't get this treatment. Here's what improved specifically for 2025. The new tax law states that intangible drilling costs are no longer required for corporate alternative minimum tax calculations. This removes a potential tax complication that was hurting some investors. This change particularly helps corporate investors and some high-income individuals who might have been subject to alternative minimum tax on their oil and gas investments. Let me show you the potential impact. Invest $100,000 in an oil and gas deal. Maybe $75,000 qualifies as IDCs you can deduct immediately. In the 37% tax bracket, that's $27,750 in tax savings the first year. Your out-of-pocket cost drops to about $72,250. If the well produces, you get ongoing income plus the depletion allowance. Even if the well fails, you've offset a large portion through tax savings. The risks are substantial. Oil and gas prices fluctuate wildly. Many wells don't produce as expected. Regulatory changes can impact profitability. These investments are generally only suitable for accredited investors who can afford losses. You typically need to invest directly in drilling operations, not just oil company stocks. This requires finding reputable operators and understanding complex partnership agreements. For our final strategy, let's look at something that works for almost everyone and got more predictable in 2025. Chapter 10. Tax loss harvesting. Tax loss harvesting turns investment losses into tax savings. This strategy works for anyone with taxable investment accounts. The concept is simple. Sell investments that have lost value to realize losses. Use those losses to offset capital gains from other investments. If losses exceed gains, you can use up to $3,000 to offset ordinary income each year. Unused losses carry forward indefinitely. This means you're building a bank of future tax savings. The new tax law locked in capital gains rates permanently. Long-term capital gains rates of 0%, 15%, and 20% are now stable. This means you can predict exactly what you're saving when you harvest losses. Before 2025, there was uncertainty about whether these rates might change. Now you can implement tax loss harvesting with complete confidence in the tax savings. Here's the process. Say you bought a stock for $10,000 that's now worth $7,000. You also have another stock you bought for $5,000 that's now worth $9,000. Sell both. You have a $3,000 loss and a $4,000 gain. The net $1,000 gain is what you pay taxes on instead of the full $4,000. Bringing it all together, your 2025 action plan. These 10 strategies got major upgrades for 2025 thanks to the One Big Beautiful Bill Act. Some benefits became permanent. Others got restored after being weakened. The overall result is the best tax saving environment we've seen in years. The key is starting now and being consistent. These strategies work best when you implement them systematically over many years. The compound effect of tax savings plus investment growth creates serious wealth over time. Remember, tax laws are complex and these strategies require careful implementation. What I've shared gives you the foundation, but you should always consult with qualified tax professionals. Click the link below if you are looking for a referral, or if you want to continue learning, click one of these videos coming up next. As always, thanks for watching, and I'll see you in the next video.